Hi, welcome. My name is Jordan Bradford, and I'm a senior advisor here with Burkholder Wealth Management. I'm here today again with our CEO and founder, Eric Burkholder, and we're going to dive in a little deeper on some investment philosophy today. So if you haven't had a chance to check out our video on our overall investment philosophy, I would highly encourage you to sit down and take a look at that one. But today we're going to be diving in a little deeper with a specific topic, which is the value premium. So as we talked about last time, there are three main premiums that we're trying to capture in our investment portfolios. One of which is value, one is size, and the last one there is profitability. But today we want to specifically hone in on value. So I'm going to ask Eric a few questions about what that means and how do we actually go about accomplishing this in our portfolio management. So I guess let me just kick it off, Eric. What is the value premium?
Yeah. So of the premiums, the value premium is probably the one that's been around the longest, and probably I think the most understood of what it is, but maybe a little misunderstood in what the implications of it are, which I'll get into. But a value premium, it's in the name, right? It's the idea that if we buy securities, companies at a better value than other companies, they tend to perform better over time.
Right.
And there's several different ways we measure value. But it all comes back to some type of measure of the price you pay. So that's the stock price you see on the ticker versus, the underlying intrinsic value of the company. So there's earnings, so a lot of people out there have heard of PE, that's price to earnings. So how much earnings do you get for the price you pay, right? Or price to book. This would be more similar to maybe if you're buying a piece of property, a house, and you'd say, what's the price I pay for, just the construction costs of that home? There's some difference there. So the closer you can get to the actual cost or underlying value, the better deal you'll get, and ultimately the better rate of return.
Right, like discount shopping in the market.
Exactly. It's often compared value versus growth. I don't really love that comparison because it makes it sound like value companies aren't growing, which is not the case. But the growthier part of the market, as we would refer to that, are just companies that trade for very high prices relative to what you get.
Right.
And over time, on average, those tend to underperform. And so we really want to hone in. We're going to own both, value and growth companies, but we're going to tilt your portfolio to value-oriented companies because we can see in the data over long periods of time, those tend to do better.
Right. So when an investor is asking or curious about value versus growth, is it helpful to think about it more on the terms of whether you're buying the stock at a discount versus buying a very expensive stock?
Yeah, exactly. Yeah,
okay.
That's what we're talking about. And so, and excuse me, we can, again, going back to real estate, that's a little bit more tangible. People can kind of understand that, but it's the same concept. So, if you buy, a little house in, say, San Diego or California, San Francisco, you're it probably is already very highly priced, and you're kind of hoping it continues to go up in price. The intrinsic value, or really the underlying value of that home is not really changing. You're just kind of hoping that someone else down the road will pay you more than you paid for it. That's the growth side. You can make money doing that, but it's very difficult, and over time you tend not to. As opposed to someone who's looking at a piece of property that is, trading at a discount, as you said. So you're not just hoping the price continues to appreciate, but maybe, there's actually rental income, and you're paying for that rental income, and getting a really good deal on that property, and just like getting a deal at the store, you would expect that to be better off.
Yeah, and so if we look back in the history of the stock market, is there a premium that we feel is confident in terms of like an average premium that the value premium has?
Sure. Yeah, there is an average premium.
Yeah.
We'll get into maybe a little bit what that looks like on a year-to-year basis, but if you go back to the longest period of data we have, about 1927, value stocks on average have outperformed about 4% a year versus growth stocks.
Okay.
Yeah, and so that's a significant outperformance. So,
yeah.
And when we talk about the premiums, right, that would be on top of the market. So,
right.
Say just for easy numbers, let's say the average company does 10%, you get 14% on average for investing in value companies.
Oh.
And so that's significant, although the way it shows up is quite a bit varied. And
Right.
Maybe I'm jumping ahead. I think you were going to ask me this, but I'll go into it. If you look at the last 3 years, a perfect example, there's been no value premium, meaning you got no extra return for owning value companies. Growth companies have just skyrocketed up until really, very recently.
Right.
They've come back down to earth hard, but it's very difficult to time the value premium, and it comes and goes in spurts. So we really want to be exposed to it all the time.
Okay.
Right? It increases our odds that we're going to capture that premium, because although it's 4% on average, it tends to comes in spurts. So some years it'll be very big, and some years it'll be negative. On average, we get 4.
So we don't have any sort of secret sauce, if you will, in terms of figuring out when that premium is going to show up.
Exactly, and that's a very common question is, can you time the value premium? Can we get in at the right time and just own value companies? And then you maybe jump into like high-tech growth companies, and the data shows it's very unpredictable.
Right.
And when it comes strong. And so you want to already own those companies, and then eventually you're going to see that price appreciation, that outperformance. But we want to own them all the time, because if you try to get in and out, you are more likely to probably own them when they don't do well, and then not when they do.
Right.
And another point to that is, that's why when we talked about in the last video that people should check out, each of these premiums need to exist among different markets and have a broad diversification about them. Because if we can own value companies in the U.S. and international, emerging markets, and small companies, then it's more likely we're going to capture that premium. Versus if we just bought U.S. large value companies. That would be one very small sector of value, and it decreases our odds of capturing that.
Yeah. And you hear from us a lot. We talk about diversification all the time and how important that is. And I think that even with the value premium, which feels like it's a pretty specific premium, but because it shows up in international companies, and it shows up sometimes with small companies, sometimes with large companies, I think it just really hits home as to why a portfolio that's well managed needs to be really well diversified and have exposure across all markets. You mentioned the last 3 years where growth has outperformed value, and if you were just investing in value, you probably were feeling a little underwhelmed by your performance. But if you've been investing in some growth, some value, and you tilt it a little bit towards value, we feel over a long period of time, you're going to have that outperformance. You're going to see it at some point, but we can't tell you exactly when that's going to be, because if we knew that, the investing would be very easy.
Right. We wouldn't have a job.
Exactly. Everyone would just know exactly when, and you'd be pulling the right strings at the right time, and there wouldn't be a whole lot of nuance to it.
Right. Another thing I'll mention about value, although value stocks are also volatile, and the market in general is volatile, investing always has risk associated with it. But I think a lot of people are seeing now another kind of silver lining of being value oriented is, compared to the growth companies, they are less volatile on average.
Right.
And so the people who maybe tilted towards growth had a really good run the last 3 years, and now those growth companies are really crashing to earth. And there's many charts that we can show now, whether it's Meta or Netflix or a lot of these, they had a huge peak, and now they've had a huge crash. And if you plot that against value companies, the value companies just kind of went slow and steady here, and now the growth companies are back even or below.
Right.
And so, as we think of clients and how they can be successful, we think, are they going to be able to stay for that ride, or are they going to be able to stay in that slow and steady wins the race pace? And so we think that not only the data shows you'll get more return over the long term, but that experience is probably going to allow people to stick with it, especially during times like this. when the market's already down, we don't need to add in more volatility.
Right. Yeah. I think you hit the nail on the head with the experience. I think it's something that is not talked about enough in the investment world, but having an investment experience that you can stick with and that you can feel comfortable with in good times and in bad times is very valuable. No pun intended.
Yeah. Or intended. I think it was great.
Yeah, so I think this was great. Great information on the value premium. We're going to do some more videos on the size premium. We're going to talk about profitability premium.
Yeah.
We're going to dive into a little bit more detail on international investing as well. So amongst a number of other video topics that we've got lined up. So if you like this information and this has been informative for you, continue to tune in. And if you have other video topics that you think would be of interest, let us know. We're happy to sit down and talk about some different investment strategies and philosophies that fit with what we do and how our clients are successful. So we're happy to have you. Thanks for tuning in again, and we'll see you next time.
See you guys.